So I want to start out with a movie quote. With a gun barrel in your teeth, it's you only speak in vowels. Anyone knows which movie this is? No one? It's Fight Club. Opening scene in Fight Club. And I think it's a great way as an introduction for storytelling. And we're going to do the same thing here. What's the first rule of Fight Club? Does anyone know that? Have you seen the movie?
No one talks about Fight Club.
You don't talk about Fight Club, right?
Yeah.
You do know that one?
Yeah.
All right, cool. So I'm going to break a rule here, similar as they do in Fight Club, and I'm going to tell you like a story from the trenches from one of the experiences we had trying to pitch to VCs. And then basically in my hotel room, having a sleep and being poked awake by my co-founder at, let's say, 8 in the morning, completely freaked out saying, we're supposed to be in a breakfast meeting with the guy that's going to do the technical due diligence of our company in 30 minutes. And I'm actually breaking a cold sweat because actually I didn't sleep that long because the night before we were having vodkas with a couple of our customers. So I was basically hitting the pillow at 3 a.m. So imagine that and the fact that we were actually on Sentosa Island in Singapore. So it's like you're sweating and it's really warm outside. You have to walk to the next hotel to meet with this technical guy who happened to have like 5 patents on his name in our storage, cloud storage and backup space. I'm the CTO. My co-founder is the CEO, he's commercial co-founder, so he doesn't know shit about technology in comparison to me. And I'm feeling so bad during that first 5 minutes of the meeting, I'm just deciding to run off and go to the bathroom to kind of fix myself up. And as I do that, I get this death stare of my co-founder going, what the fuck are you doing? And we still ended up closing that actual investment. So the good news here is that you might be in a bad situation in a personal level, but we still find a way to actually convince that investor that they should invest in us, despite that first impression we made. And the lesson learned here is that you might question yourself saying, why were you in Singapore to meet with an investor in the first place? Couldn't you found a VC in the Netherlands, just like today in Rotterdam? But we were very, very picky about what kind of investor we wanted to work with in the first place. So we did a lot of, let's say, of our own research, also as founders. And we met with these investors way, way before we were actually in the market for a round. So we kind of like used the informal occasions where they would come up at trade shows that we visited as well to get acquainted, to see what they're looking for. And a couple of things I learned from a VC perspective is that for venture capital firms, but also for business angels and investors that do these kind of like high-risk deals in general, there's basically 2 ways they look at deals. There's the way of seeing it as a lottery ticket. Is this a company that can potentially give me a 20 times return? Because ultimately across the entire portfolio of VCs, what I've learned is that they basically want to bet on these kinds of lottery tickets across their portfolio. So you need to come up with a story that gives them an idea that this could happen with your company. It's obviously a forward-looking statement, but they need some sort of compelling reason why this could potentially be you and your team and your market and your traction hitting it up to hundreds of millions of revenue potentially. And at the same time, they do also care about downside risk. Like they're looking for the worst possible outcome being that you just have a healthy business and that somehow it didn't work out completely to become, let's say, this great company. But still, there is some value there, and you have paying customers, or at least you have, let's say, something that goes for you to be an entrepreneur that's going to end up running a healthy business. So in our case, that was an easy statement to make because we already had lots of paying customers. And we were in a market where we knew they had the intelligence and the network to help us with that, because some of their limited partners behind the fund were in other backup software companies. So we knew those backup software companies at some point would be interested in buying our cloud backup company, because we were in a new market and a new way of working, which is SaaS and cloud, which back then was kind of like revolutionary. So I wanted to tell you about this a little bit. What I also want to tell you about as from the investor side of things is that I think that smart investors kind of like invest in our deal flow really early on. So I think there's a situation now where there's more money flowing into the market from all sorts of different angles because of low interest rates, for example, on savings accounts. But at the same time, there's more and more founders. So I think the smart founders will always be very picky and very conscious about who they want to work with. And they're probably going to build up relationship with investors very early, very soon. And at the same time, investors, they can't stay passive anymore. They have to basically be the first ones to meet with these founders. Because if you're just going to sit and wait, you're going to run into these other categories founders that are maybe not that high of a potential, and they're not going to make it as far as the good ones. And if you wait until those people come and knock on your door, the signal to noise ratio will be pretty high. So this is also what brings me to the part about Firmhouse. We see this particularly also now as a problem, or at least a potential way of working for business angels. So we're starting basically a fund of our own, which is called Firm Builders, where we look at these companies with the potential of being a healthy business for the least and having a shot at, let's say, a bigger success. And we want to basically organize ourselves as a syndicate in which we, with our network and our intelligence inside all these accelerators and what we learned from there, can spot founders earlier and have access to them before anyone else does. So that's basically the principle we are also applying here. And I think it's a future for, at least for the business angel community, to syndicate up and to appoint a primus inter pares who is going to do all the hard work for you, basically. And then to bring it back to the healthy business part, when you are a founder, if you're not in any way, let's say, in a good position right now when it comes to your business and you have a big risk of completely running out of runway, there's always this problem that founders sometimes make this mistake, that they come up to the VCs and investors too late, and then you end up being Tyler Durden. You have this gun in your mouth, and you have no other options, basically. So that's one thing I took from Fight Club. It's like, you have to avoid a situation where you have no choices. The other thing I wanted to tell about the story about Fight Club is, I think Chuck Palahniuk, the writer, the author of Fight Club, actually does a very good job teaching others about storytelling. And it's interesting to look at what he basically writes on his blogs about how to compile a nice story. So I'm going to give you that as a minor tip. Make sure your story is about how great your company can be, how plausible it is that you can get there, how great your team is going to be, how big your market is, how good your traction is, but at the same time, include some elements in there like, we're going to make it anyway, we probably don't need your money, we're going to be a healthy business no matter what happens, and if you're doing that, then I think you're going to be in good shape today. And that's it.